A nightmare is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a leaked government report exposes an unthinkable crisis is on the horizon. And I want you to see that this first started with Treasury Secretary Janet Yellen when she announced an unexpected buyback program. And then yesterday, we hear from Fed Chair Jerome Powell a sudden shift in his view of the economy. And what you want you to understand is everything to do with this report and the fact that the government now knows that the U.S. economy is likely to head into a deep recession. Now let's over to Bloomberg, where he picked today's story up with a headline as Powell keeps rate cuts on the table but leaves timing less certain. And this is a huge shift from the Fed chief, because we've continued to hear that rates need to stay high and even for longer, to the fact that he's been willing to push them back to see inflation come down. And now all of a sudden he's being less certain about the timing of the future cuts. The question is, what is driving this sudden shift? Well, it's not inflation. It's this government report that shows us the economy is in far worse shape than even we want to believe. As Powell said on Wednesday following the U.S. Central Bank's latest meeting in Washington, he said that price growth will likely resume cooling this year, but avoided offering a timeline for rate cuts. And this is, again, a surprise move from the Fed chief, who has been fearful that we're going to see inflation rear its ugly head for a second time, which is largely the belief of consumers. Now all of a sudden he's suggesting that inflation is indeed going to come down, as if he's eager to get a first rate cut on the board. And Powell's remarks reflected a broader shift in thinking at the Fed toward holding borrowing costs at a two-decade high for longer. That change in tune, which is absolutely critical here, first voiced last month, represented the culmination of several months of firm increases in inflation, hiring, and consumer spending that has also led investors to pare back bets from roughly 6 rate cuts this year to just 1. And all of a sudden here, we see that Powell should be coming out and speaking confidently about the economy, suggesting that the rate cuts are here to stay and that maybe we would only see 1. Now he's getting wishy-washy, and well, there's good reason. He knows something bad is on the horizon, as the Fed chief also established a high bar for further rate hikes, suggesting that now a hike is off the table. And it wasn't only a matter of months ago that he suggested that if inflation was to come back, he would actually need to raise rates, now suggesting that that's an impossible outcome, saying it's unlikely that the next policy move will be a rate increase, as officials would need to see persuasive evidence that policy isn't sufficiently restrictive to bring inflation down to their 2% target to consider raising rates again. And this is, again, a shocking move, because we've seen them say that rates are not restrictive enough. Now he's suggesting that they are restrictive and that we're soon going to see inflation come down, which is why he's eager, again, to get some cuts. Because when I show you the report, you're going to be shocked that they already know what's coming. As officials also announced plans to slow the pace at which they're rolling maturing assets off the balance sheet beginning in June. The cap on Treasury runoff will fall to $25 billion per month from $60 billion, while the cap on mortgage-backed securities will remain at $35 billion. And this too is coming to surprise to many people, because even though we anticipated that the Fed would have to reduce the pace of quantitative tightening, we knew this years ago, this amount is actually bigger than anticipated. And if you think back, Fed Chair Powell used to say that the Fed will continue to use the funds rate as their primary policy tool and let the balance sheet run off. Now we're getting a sudden shift that they need to see rates come down, and in a big way, because again, the economy is not in a position that we all thought it was, and it all is coming back to this one report. And speaking of one report that makes a difference, well, we have a recent trade. This came out on April 25th. Now, meanwhile, the U.S. equity market was in a downturn here, and this has a close of business yesterday. You wonder the power of our reports. You can see it right here. This trade was a pair trade, came off of our CTA and Momentum Timer Pro reports, now up 3.66% and even driving higher in today's trading. How do you get such great information about where to invest your money? And in fact, today in our video, we talked about some positioning for those of you that have large asset called your 401k or your retirement IRA. We gave you you some tips. And how do we do that? Well, we leverage the machine positioning. We look to show you how to buy before they do and get out before they sell. It's called our CTA Time Pro. This gets you some super deep signals. We put out a report every day and a video walking you through the trades, but maybe you just like to trade the technicals, things like the RSI and the MACD. Well, we got our Momentum Timer Pro, but instead of getting in late and out early, we show you how to time the trade better, stay in it longer. You get a report plus the video. Again, this isn't just about trading. This is about maximizing the return on your biggest asset, and we give you a 30-day free trial. My friends, make it pay half price. We give you 30 days. Links in the description below. Check them out, because I do think the evidence shows pretty clearly that not only our reports are great, but the policy is restrictive and weighing on demand. And this is a big shift from the Fed chief, that suddenly he said we're seeing demand start to have an impact. And this is not something we've expected to hear from him, but the reality is something has changed in the economy that's not being reflected in the consumer price index, and this has gotten the attention of not only Janet Yellen, but Jerome Powell. And here we can see this from CNBC. Long predicted consumer pullback finally hits restaurants like Starbucks, KFC, and McDonald's, suggesting we don't have a supply problem. We indeed have a demand problem. And this is a case that we've been making on the show, that the Fed, by constraining demand, actually shoves the economy down into a recession. We're finally starting to see that happen. But those excuses don't fully explain the weak quarterly results. Instead, it looks like the competition for a smaller pool of customers has grown fiercer as diners still looking to buy a burger or cold brew become pickier with their cash, suggesting that indeed we have a slowing economy where consumers now are struggling financially. We've been making the case that this was going to happen. Now we're starting to see it in earnings, and we're starting to see it in oil as oil prices rise after dropping 7-week low on U.S. inventory gain. What we're seeing is inventory builds here, suggesting demand for energy is falling as well. And we made the case that higher energy prices would not be inflationary to the extent that consumers could not afford higher prices. Sure enough, we're seeing that, and that's back feeding into, of course, those stocks like McDonald's, KFC, and Starbucks. As oil has lost more than 5% this week after soaring last month to the highest since October following Iran's attack on Israel. The decline comes on signs that easing tensions in the Middle East, including prospect of a historic pact between Washington and Riyadh, has worries that the Federal Reserve will keep rates high and further damp demand in fuel markets at the onset of the summer driving season. So this is interesting that we're seeing such a decline in demand, and this is exactly what the Fed didn't want to happen at this level. They wanted to bring demand down, and they want to do this every cycle. We warn, if you bring demand down too much, you tip the economy into recession. You should focus on increasing supply. Of course, the Fed has no tools to do that, and now we're seeing the consequences as consumers are struggling. And here we see from that leaked report, the government actually knows what's coming here, because they cite several issues. One, valuation pressures arise when asset prices are high relative to economic fundamentals or historic norms. And these developments are often driven by an increased willingness of investors to take on risk. And as such, elevated valuation pressures may increase the possibility of outsized drop in asset prices. So this, from a recent financial stability report, suggests that the Federal Reserve and the government is concerned that asset prices are too high, and sure enough, they have every reason to. As we see the Wilshire 5000 price index, or the total U.S. stock market here, against corporate profits after tax. And what do we see here? That the stock market is leading. You see it in blue against corporate profits, as investors believe that they're front running a huge run up in profits. And this, from the Fed's perspective, is creating issues of valuation, could lead to outsized drop in stock prices. And you start to think now, why do we see this sudden shift with Janet Yellen? It had to do with the banks and needing to get those assets off the bank's balance sheet that are paying low yields, get them higher yielding assets so they can be competitive in the depository market by attracting cash back. Now we're seeing from the Fed saying, wait a minute, asset prices may be too high here. We need to do something, because the issue, what we see with the Federal Reserve every cycle as they get into this extreme mode of restrictive monetary policy. And the issue is they always take it too far. They're the ones that pop the bubble, as excessive borrowing by any business and household exposes borrowers to distress if their incomes decline, which is something we have noted is happening, or the assets they own fall in value. And of course, that makes sense of why they're so afraid about real estate prices falling in value, because we saw what happened during the great financial crisis when consumers stop paying on their debt. In these cases, businesses and households with high debt burdens may need to cut back spending. There's your discretionary side. There's the demand that we're seeing affecting economic activity and causing losses for investors. And so there we come right back to what's going on with McDonald's, KFC, Starbucks. We're seeing demand go down because consumers have high debt loads and their incomes are going down. And we can see that here very clearly with total consumer credit owned and securitized, that's shown in blue, against total compensation, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. This shown in red on a year-over-year rate of change. And what we can see very clearly, particularly as we get into the global financial crisis, that a deceleration leads to a recession due to high debt loads. You can go back to the dot-com bubble. You see it happen as well. That deceleration, consumers can't afford to pay on the debt. In fact, you can see this virtually every cycle. The decelerations send us right into a recession due to high extreme debt loads because consumers can't make the payments. So now you see there's some very clear evidence from this report that the stability of the U.S. financial system is not as strong as the political elites want us to believe. In fact, leverage in the financial sector, as we look at the banking sector, remains sound and resilient overall, and most banks continue to report capital levels well above their regulatory requirements. Nevertheless, fair value losses on fixed assets remain sizable for some banks. This is what they're referring to as those unrealized losses on those treasury and mortgage-backed securities that the banks are sitting on. One of my cases why, when we head into recession, the Fed will have no choice but to go back to zero to try to put these assets in the green so the banks can sell them. But look at this, with some banks with concentrated exposure to loans, get this, backed by commercial real estate, something we've been warning as they experience stress in that sector. Meanwhile, outside the banking sector, data suggested that hedge fund leverage grew to historic highs, driven primarily by borrowing, while the leverage at life insurance companies remained around its median while they continue to take on credit and liquidity risk. And what did we hear Janet Yellen say she needed to do this buyback program for just yesterday? Well, due to liquidity risk. So you can see the government now is panicking at a level we haven't seen in a while. And they're trying to do it very carefully because they don't want you to know what this report says, because they're also concerned about funding risk as liquidity at most domestic banks remained ample. Well, except for Republic First, with limited reliance on short-term wholesale funding simply because nobody wants to go to the discount window. And nevertheless, some banks continue to face funding strains, suggesting they know there's problems in the banking system, likely owing to vulnerabilities associated with high levels of uninsured deposits, declines in the fair value of assets. Again, there's that case why I say the Fed goes back to zero, and elevated exposure to commercial real estate. Structural vulnerabilities remained in other short-term funding markets, such as prime and taxes at money market funds, as well as other cash investment vehicles and stable coins remain vulnerable to runs. So you can see even bond and loan funds that hold assets that can become illiquid during periods of stress remain susceptible to large redemptions. In addition, life insurance continue to rely on a higher than average share of non-traditional liabilities. So what you see here across the board is financial stability in the system is a risk now. The government realizes it because the Fed has put themselves in a position where they can't cut rates due to inflation. Even though we've noted in the past that isn't a factor, they're trying to position themselves to get ahead of this crisis. And here you can see in the survey that persistent inflation and monetary tightening, well, that means 72% say that was an issue. But how about the big one, policy uncertainty? This is coming right from the Fed itself, in addition to commercial real estate, banking sector stress, and fiscal debt sustainability, suggesting the government knows right now we are indeed headed into a crisis. And they're not the only ones that know that. It's consumers. But the surprise is there's one group that doesn't know, and that's businesses. As U.S. businesses are way more optimistic than consumers, this according to a recent poll, as the survey found business leaders are much more optimistic than U.S. consumers about navigating recent economic instability, technology disruptions, and societal shifts. For example, 79% of business leaders are optimistic about the future of the world versus 34% of consumers. So now we look back to a lot of these business surveys and we can see there's a bias toward optimism. And then when consumer spending continues to collapse, we should see a giant shift in sentiment out of businesses. That will not be good, of course, for the U.S. equity markets that the Fed is suggesting could be in a bubble. As U.S. business leaders are optimistic about business strength, but for many Americans, the economic recovery is a reality yet to be experienced at home. This is something we've been very clear that we've known for a while, as almost 3/4 of consumers agree with a statement that economists may say things that are getting better, but we're not feeling it where I live. And it's simple. We talked about total compensation growth continuing to slow against inflation that's at least temporarily maintaining a sticky level. Even the Fed says it's coming down, but it's coming down because the U.S. labor market is going to struggle, as more than 60% reporting putting major life decisions on hold due to today's economic uncertainty, meaning spending about to go down. And we see that here in the Chicago area as the fastest drop since Lehman. Chicago PMI puke screams stagflation. Of course, we know that periods of stagflation lead right into a recession, because if consumers can't afford higher prices because they don't have the wages, well, that means spending goes down and the recession becomes inevitable. As miraculously surging two-year highs back in November 2023, the Chicago PMI has plunged for 5 straight months, with the last 4 months seeing the month-over-month declines accelerating. Against expectations of a rise to 45, April's PMI printed a staggering 37.9, and this is financial crisis level stuff. As you can see on this chart, the last time we've seen this, we were in the depths of the dot-com bubble or the global financial crisis, a pandemic, and now we're back at these levels. And as you can see, we're not even close to the bottom, and you can now start to get very clear why the Fed's panicking here, why the Treasury's panicking. They're trying to do anything to get some cuts or get some policy easing on the board here to keep the economy going before it gets all outright catastrophic. But look at this, prices paid rose at a faster pace, new orders fell. That simply tells you people can't afford higher prices. Employment fell, that means demand is going down. That happened at a faster pace. Inventories fell at a slower pace. Supplier deliveries at a faster pace, signaling contraction. Production fell, and order backlogs, they fell as well, suggesting across the board things in Chicago aren't looking good. And if that starts to feed across all of the manufacturing space of the United States, well, watch out. We're soon going to be in what I call the nightmare scenario, which I believe is coming soon. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.